In our Chapter 6 PowerPoint, we basically walked through calendar year. Why does it keep doing that? If we are on a calendar year client, that means that their accounting period is January 1st to December 31st. Sort of where are we right now? We are at the end of spring, early summer, where we are getting an understanding of our client's internal control. We are just trying to figure out, what does their internal control system look like? How has it been designed to prevent and detect misstatements? And the way that we sort of plowed through that discussion was with these different components of internal control. So these are the things, this is the framework that Earthware should be using to establish internal control within their business processes. This is also the framework we as the auditors use to understand Earthware's internal control system, right? So we look at their control environment, thinking about more generally, what's the tone of the environment around internal controls? How do they establish policies and procedures over the entire entity in terms of how they want things to run? How do they hold people accountable? So we said for this, we would look at sort of policy manuals, employee handbooks. We would talk to management about how they set the tone around internal control. Then we said, we also need to understand, what's the entity doing about internal controls themselves, right? How are they identifying risks that could have an impact on their financial statements? What are they doing about it? And I mentioned to you before, the answer should not be, oh, they wait for the auditor to get there and identify risk. Absolutely not. Earthware should be identifying their own business risk before we step foot on their, before we step foot in their business. And then we said control activities. This is the one that we're going to explore in much more detail in Chapter 7 when we get back from fall break, because we're going to be looking at what are the specific activities that Earthware has in place in their revenue process that is meant to prevent and detect misstatements. So when we talk about control activities, we say Earthware needs to be identifying what could, no, I spelled that wrong. What could go wrong, right? Within their revenue process, where are their things? What activities are they putting at those points in the process to make sure it doesn't go wrong, right? Those are the control activities. That's what we will explore more in Chapter 7. Information system and communication, again, one of the components of internal control. How do they inform their employees about internal control? How do they communicate financial information both internally and externally? And then finally, monitoring. What is the process that they go through to ensure that, yes, once internal controls have been designed and implemented, they can't just walk away and say, okay, we did it, we're done now. They have to, on an ongoing basis, monitor to ensure that those internal controls are actually still operating to prevent and detect misstatements, because technology changes, personnel changes. They may go into a new product or service line. They may expand overseas. That creates an international business rather than a domestic business. Those changes to the business will ultimately have an effect on their internal control system. So they have to monitor it over time and figure out, if our business changed, how did that change our internal controls? What do we need to do to ensure that those internal controls are still preventing and detecting misstatements in the financial statements? We said we have to make sure that we understand the IT system and what impact it could have on the internal control system. And then once we gain this understanding, again, by examining employee handbooks, by looking at policy and procedure documents, by inquiring of the managers of the business to get an understanding of internal control, we have to document it, right? And in your case study, the way that you documented it is through a questionnaire. So you were provided information from the client in those Word documents that were embedded in the case. And that information allowed you to answer specific questions about earthware controls, what their risk assessment process was. Okay, so those more general aspects of internal control, you were documenting in the questionnaire. The more specific aspects of internal control, that one component of internal control that's more specific is control activities. Those are going to be the specific things that they are doing within a process to prevent and detect misstatements. The way that we typically document control activities is through flowcharts and narratives. So we would get an understanding of how their revenue process works. From the time a customer places an order to the time that customer pays off their bill, what is the process? What are the steps that take place that allow Earthware to generate revenue? We would get an understanding of that again by inquiring of their employees, by inspecting different records and documents. If they say that a customer places an order online, let's look at what the online system looks like, right? Let's see how that actually works. We would observe, we would inspect, we would inquire in order to figure out from start to finish, how does the revenue process work, right? And then we can document that understanding either in a flow chart where we can different departments that are involved, the different documents and records that sort of flow within those different departments, or we could create a narrative where we would actually tell the story sort of like in a memo format of from the time the customer places the order to the time they make their payment, what happens in order for Earthware to be able to generate revenue. Okay, this is where we left off. Okay, and as I mentioned, you will still have class time today to work on that internal control questionnaire that you have for chapter 6 case study. But I want to move on to now understanding of our client's internal control to help us establish an audit strategy. Okay, so I presented that term to you way back in like chapter 1 or 2, that we have to use our understanding of our client to come up with our audit strategy. What approach are we going to take when we're conducting our audit of this particular client? There are two general strategies that we can use and format our audit plan around controls in the audit of the financial statements. Okay, the way that we choose the strategy is by answering that question in the middle of our diagram. Do we intend to rely on the client's internal controls? And it is a yes or no question. Do we intend to rely on the client's internal controls? Okay, so let's think about this for a second. We have gathered all of this information about Earthware, about how, their control environment, what's the tone, what's the overall policies and procedures that they follow. We have gained an understanding of their business processes to figure out how does revenue work, how does purchasing work, how does payroll work. We get this understanding, but that is just showing us how their internal controls have been designed, okay? Based on that understanding, we have to be able to answer this question. Do we think that Earthware's internal controls have been designed correctly? We don't know whether they're actually working yet, right? All we can assess at this point in our audit is, have they designed and implemented an internal control system? Does it appear as though they have an internal control system implemented? Yes or no? If the answer is no, we're going to go no first. We move over to the right-hand side, and you see the strategy that we take is called a substantive strategy. Okay, so again, we have two general choices here. Now, our audit client obviously is going to look a little bit different depending, from client to client. But the overall strategy, we're going to pick from these two. Okay, so if we take a look at Earthware and we realize that they don't have a lot of policies and procedures in place, that they're not really monitoring what's going on within their internal control system, that they don't necessarily have a formal way to assess their own risk, to identify their own risk. If we are sort of answering no to all of those questions, what we are ultimately saying is we cannot trust that Earthware's internal controls are going to prevent or detect misstatements. We don't trust their system of internal control. Are you with me? If we are answering no, we are saying we don't trust their internal controls to prevent or detect misstatements. We answer no, we take a substantive strategy, okay? Now, let's think about this for a second, if this would let me. Let's think about this for a second in terms of our audit risk model, okay? What we are essentially saying in this process is we are trying to make an initial, I can't emphasize that enough, an initial assessment of control risk, right? So what we're saying here is that we have already assessed inherent risk. We just got an understanding of the client in general, and we're able to assess whether there are weird, funky, and complicated things going on, right? That's inherent risk. Is it weird? Is it complicated? Is it funky? Okay, that's already done. We're done with that. We now are using our understanding specifically about internal control to make an initial assessment of control risk. This is not our final conclusion on controls. This is just our initial perception of whether or not we think Earthware has an internal control system that is designed to prevent and detect misstatements. We don't know yet if it's working. That's why this is just an initial assessment, okay? But again, thinking about that audit risk model that we talked about in chapter 4, we are trying to figure out what level of control risk do we think our client has. If we are answering no, we do not think, right? So if I go back to that model, if we are answering no, we do not think that their internal controls have been designed to prevent or detect misstatements. We will take a substantive strategy, and what that means is we are assessing control risk as high. If their control risk is high, that means that we think their system of internal control is not ever going to prevent or detect misstatements. We can't trust it. Are you with me? If we can't trust their system of internal control to prevent or detect misstatements, well, then that leaves it up to us in this substantive strategy. In this substantive strategy, if we set control risk at high, then that means we would have to set our own detection risk at low. Detection risk, right? Let's remind ourselves. Detection risk is the risk that we are willing to bear, that we may not find a misstatement, right? What are we willing to put on our shoulders that we may not find a misstatement? If their controls are so terrible that we can't trust that their own systems are going to find the misstatements, then we need to be sure we find them all. Are you with me? In order to make sure that we find them all, our detection risk needs to be low. And if our detection risk is low, so is our materiality. And that means we're going to have to audit a lot of stuff. Okay? So in a substantive strategy, what we are doing is saying we don't trust their internal controls. Their internal controls are supposed to prevent and detect misstatements. That's what they're supposed to do. But based on this initial assessment, we don't think that's happening. We don't trust their internal controls. Therefore, we have assessed control risk as high, and that means that we would have to we would choose a low detection risk. Because we don't trust their internal controls to find the misstatements, we got to find them all ourselves. And again, does that mean that there are an abundance of misstatements? No, it just means that the risk of their own systems finding the misstatements Not very likely, right? They have high control risk. Their own internal controls aren't going to find those misstatements. So if they're in there, we have to find them. The auditors have to find them. Okay. So in this substantive strategy, we set control risk at high, and we can do this not necessarily just for like the overall financial statements. We can look account by account and say, okay, you know what? They actually have a pretty good system of internal control around the revenue process, but payroll, right? So we could decide to take a different strategy with each individual business process, depending on what we find in our assessment of internal controls, okay? But the idea here is that if you are saying that you can't trust their internal control system, you don't believe that their internal controls are actually going to prevent or find misstatements, then you set control risk high, and that means that your detection risk has to be low. You have to find those misstatements that are in there because their systems aren't going to find them. Are you with me? This is the substantive strategy, okay? That is when we are answering no to that initial question. Does the auditor intend to rely on controls? No. That means that, look, in this diagram, we skip all the way down to let's just document that their internal control system sucks, and let's move on to our financial statement audit. In this substantive strategy, we wouldn't even bother testing whether their controls are actually working. We wouldn't even bother. Why waste our time, right? Because we've been able to observe and inquire and inspect different policies and procedures and things that they have going on. And our initial assessment says their internal control system sucks, or they don't have one. Remember that I gave you the example of one of the audit clients that I worked for, where they said they had a prepaid rent or something like that on their balance sheet. And we said, okay, show us the prepayment. Show us that you paid that. And they said, well, we didn't pay that yet. Okay, well, it can't be a prepaid if you didn't pay it yet. That is a complete lack of internal control, right? And so for that audit client, what we did is we said, they don't have an internal control system. It's not even that it sucks. They don't have one. And the reason why that client didn't have one is because they were a small business that had just been purchased by a private equity firm. So they had never had an audit done. They had never really had a full-blown accounting department. They were just sort of a small mom and pop type place that got acquired by a larger business. So it was reasonable to understand why they didn't have internal controls. They didn't really even understand what that meant. They didn't have the resources to implement it. So it's not that the company is bad, right? This is just our assessment. They did not have an internal control system. We took a substantive strategy. We said there is no reason why we should waste our time trying to figure out the ins and outs of an internal control system that essentially doesn't even exist, or we already can see that it sucks. Let's not waste our time. Let's just jump all the way down to our financial statement audit. So what we would do is we would form an opinion about their internal controls, because remember, we're doing two audits at once, right? We're doing the audit of internal control and we're doing the audit of the financial statements. In this substantive strategy where their internal control system sucks, all we would do is form an opinion saying their internal control system sucks. That's all we would do. And then we would move on to performing our audit of the financial statements. Are you with me? So in the substantive in the substantive strategy, we skip over testing their internal controls because we can already see it would be a waste of time. They either don't have an internal control system or it sucks. So let's just say it sucks and move on to the financial statement audit. Make sense? And again, saying it sucks or saying it doesn't exist doesn't mean they're a bad company. It doesn't mean that their accounting records are going to be completely off. It doesn't mean that they're committing fraud. It's just a fact. They don't have structures in place to prevent or detect misstatements, right? And we have to form an opinion about that. And then in this case, just move on to performing the audit of the financial. We may do our audit of the financial statements, not find one single dollar of a misstatement, right? Just because they don't have internal controls doesn't mean that their financial statements are going to be screwed up, but there is a higher risk that there are misstatements not found. Okay, substantive strategy. However, does the auditor intend to rely on controls? Your audit of earthware is going to be the reliance strategy. Because for that question, do we intend to rely on controls? Our answer is yes. You are gathering information about earthware in that questionnaire, and you are learning that it does appear that they have a system of internal control. It does appear that they have policies, procedures, and structures in place that are meant to prevent or detect misstatements. It appears like that, right? So our initial assessment of control risk for earthware is going to be low. Our initial assessment of control risk for earthware is going to be low. We believe, based on what we've seen so far, we believe that they have a system of internal control that is designed to prevent and detect misstatements. So if the answer is yes, we intend to rely on controls, then we do take the next step in our internal control audit, and let's actually test that their controls are working, right? We can see that they've designed a good system, but if nobody's actually doing the tasks, if the IT system is malfunctioning, right, then that means that, yeah, they designed, the blueprint looks great, but it's not actually operating the way that it's supposed to, right? So the next step in our reliance strategy, which is the strategy that we are taking for our earthware audit, is that we are going to plan and design tests of controls. We are going to, bless you, look at specific business processes, in particular revenue for our class, and we are going to figure out what types of controls do they say they have built into their revenue process. I will give you an example, okay? In their revenue process, earthware is going to say that they perform a credit check on all new customers. First of all, why is that important that earthware performs for our audit? Why would we think that that's an important control? What is it preventing from happening? If earthware performs a credit check on all new customers, what are they trying to prevent? Absolutely. Selling to customers that are actually never going to give you cash. Because you'll recall from intermediate one that one of the criteria to be able to call that revenue is that you think you're actually going to get the cash, right? If you're never going to get the cash from the customer, that shouldn't be revenue. That would be a misstatement in your financial statements. So the way that earthware is trying to prevent that from happening is by doing a credit check on new customers. Now, is that a foolproof 100% type of control activity? No, right? You can't 100% know whether the customer is going to pay them or not. But it's a pretty good check, right? It's a pretty good prevention measure. So in our reliance strategy, what we're going to do is try to test that that control is actually doing what it's supposed to be doing, okay? So again, the control is that earthware performs a credit check on all new customers before they process the order. You're the auditor. What do you do? You have to plan and perform a test of that control to see if it's actually working. What do you do? So in this reliance strategy, you are required not only to just make an initial assessment of controls and risk, but you actually then have to take it a step further and say, okay, yeah, it appears that you're performing a credit check on all new customers. That's what you say you're doing. Looks good on paper. Now we have to make sure that it's actually happening. So what would you do? What would you ask to see? Trent. The customer credit check, right? Very simply, let's get a list of all new customers that Earthware has had during our audit period. Let's pick some of them and let's see if they did a credit check before they processed their order, right? This is not rocket science, you guys. This is very logical, sort of step-by-step thinking through how would we as the auditor be able to decide whether or not they're actually performing credit checks. Let's get copies of the credit checks, right? Let's see how that actually works. And if we're able to see that they are performing credit checks on new customers, then we can conclude that control is not only designed well, it's actually working too, right? It can't just be that they've designed this really awesome blueprint of how it should work. It actually needs to work. It's about design and operation. I'll give you a little hint. This is what you're going to have to do for your Earthware test of control case study. I'm going to give you a control activity, and then you're going to have to design audit procedures. How do I test that that control is actually working? So Earthware performs a credit check on all new customers. 1, let's get a list of all new customers that during our audit period. 2, let's select a sample of them and see that Earthware actually did a credit check. 3, let's make sure that that credit check was done before they processed the order. Because if the credit check's done after they processed the order, well, then that's irrelevant. They already sold the goods, right? Step by step, what audit procedures would you perform in order to ensure that that control is working? Make sense? Okay. So this is called the reliance strategy. Again, we're going to plan and perform test of controls. And based on that, the results of those tests, we could say whether this initial assessment, right? In a reliance strategy, we're saying control risk is low, but that's just based on our sort of perception of what internal controls look like. Then we dive into them and we actually test whether they're working or not. And so then it's our job to figure out, okay, we initially thought control risk is low. Based on the results of our audit procedures, do we still think it's low? Because for that one example, what if every new customer that we asked for evidence that they performed a credit check, they had 0? We would be able to say, okay, well, their blueprint, right, that showed that they were supposed to do a credit check on new customers made us think that control risk was low. But now we actually dove into the evidence, and the evidence is showing us they're not performing credit checks on new customers. What would we have to do with our assessment of control risk in that circumstance? I'm not sure I understand. Is that what you all think too? Jack, we would have to raise it. We initially thought, based on what they told us, based on our initial assessment, we originally thought that control risk was low because they said that they were performing credit checks on new customers. Then we dove into the evidence, and the evidence showed us they are actually not performing credit checks on all new customers. They're never performing credit checks. They're selling to whoever they want. That means that this initial assessment of control risk would need to go up. We are now not very confident, right, that their internal controls are operating the way that they intended them to operate, because we can see in the evidence that they're not actually doing what they said they were doing. They're not performing that credit check. So our low assessment then becomes high. And we would have to change what we do with our detection risk. Okay. So in this reliance strategy, we can organize our testing of controls based on management's assertions. You'll recall from chapter 5. We talked about management is asserting, right, that all of those transactions in the revenue process actually occurred, that they're all complete, that they were authorized to be processed, that the amounts are accurate, that they cut them off at the appropriate time periods, right, at the end of the year. and that those accounts are classified and presented correctly in the financial statements. Those are management's assertions, right? And so what you're going to see when you actually perform the test of controls for earthware is that we can organize our audit plan based on management assertions. What kind of controls should management have in place in order to ensure that, yes, those things, those transactions actually did occur? These are the types of control activities that you're going to be examining for your audit client. Segregation of duties. Do they use pre-numbered documents? Do they do end of month reconciliations? Okay. So those are the types of things that you're going to be looking at for Earthware's internal control system, and it will be organized based on management assertions. Now, there are obviously some limitations to the system of internal control, specifically to these control activities that we're talking about. Okay. There is always going to be someone that has override ability, right? Where they can say, and it can be part of their policies and procedures, that the CEO can override certain controls about approval of things or maybe entering things into the accounting system. There's always going to be someone who has an override power, so to speak. Okay. That creates risk, because if someone can just go into their processes and change the internal controls whenever they want, that could be a problem, right? But that's where that control environment comes into play. What's the tone at the top? What kinds of policies and procedures do they have in place to ensure that that doesn't happen very often? Management override, okay? But it's always going to be a risk or a limitation of internal control. As long as there are people involved in the processes, there's always going to be a risk that someone just makes a mistake, right? And we talked in chapter, I forget, the difference between mistakes and fraud, right? The difference between mistakes and fraud is intent. There's always going to be a chance that someone just makes a mistake. They're not trying to fool anybody. They're not trying to pull the wool over anybody's eyes. They just made a mistake, period. That's always going to be a risk in our internal control system. And there's always also going to be a risk that two people could come together to try to commit fraud within the organization. That's called collusion. Two or more people coming together to try to commit fraud, right? Because we talked about this in accounting information systems. We could say, okay, Tristan has to review Jake's work. But what if Jake says, hey, Tristan, let's get in on this together, and you just sign off on what I did. That way the financials look good, right? That's collusion. And we say, okay, let's try to prevent that. Nate, you have to oversee what Tristan does. Well, then they're just going to elbow Nate and say, you're in on it too, right? And you all share in the bonus that you get. So the idea of collusion is that you're never going to be able to completely prevent two or more people coming together. Even if you have the most stellar internal control system ever imagined, you're never going to be able to prevent two or more people coming together to try to commit fraud. Okay. So these are the limitations of internal control that we as the auditor have to understand. And again, thinking just a little bit more about fraud for 1 second, this diagram in the text shows that a study that was done by the CFE, is Certified Fraud Examiner. So it's like I have a CPA license. CFE is another type of licensure that you can get. CMA, CIA, there's a million of them. But this one in particular is a Certified Fraud Examiner. And they did a study, this organization did a study to figure out what are the reasons why fraud was able to happen within organizations over a period of time. And you can see that the number one reason why fraud was able to occur is because of a lack of internal controls. Okay. So this is why internal controls are so important. Again, we don't go into every audit client assuming that fraud is going on, but a lack of internal controls, a lack of that control environment could be a red flag for us that fraud is more prevalent when internal controls are not established. Does that make sense? Fraud is more prevalent when internal controls are not established. Okay, getting back to our auditor sort of flow chart of how we assess controls. Okay, so again, we have used our understanding of Earthware's internal controls to select a strategy. If we do not intend to rely on Earthware's internal controls, we would pick a substantive strategy. We would say their controls suck or are non-existent. That means control risk is high and our detection risk needs to be low, okay? But the strategy that we're taking for earthware is the reliance strategy, which means we would have to plan and perform tests of controls. We think that their controls are working, so we initially set control risk low, and that means that our overall detection risk can be a little bit higher. We would be okay with a little bit more risk on our shoulders because we believe that their internal controls are working to prevent and detect misstatements, okay? If that reliance strategy is the case, we would plan and perform test of controls. And after we have tested controls, what we must determine is this initial level of control risk correct, right? Based on the evidence that we've gathered, are their internal controls actually working and is control risk actually low? If so, great. Move on to your financial statement audit, okay? But if not, right? Remember in that example I gave you, what if we gathered evidence about their internal controls? Initially, we thought everything looked okay, but then when we dove into the nitty-gritty details, we figured out none of those controls are actually working, okay? So does the achieved level of control risk, meaning the one that we actually found when we dug into the details, does it match up to what we initially thought it was? If the answer is no, we have to revise our plan, right? Because initially, our plan was based on a low control risk, which means detection risk we were okay with accepting. Detection risk was high. That means materiality is high. That means we don't have to audit as much in our substantive audit, in our audit of the financial statements. But if we are gathering evidence about internal control and we are realizing that actually control risk is moderate or at a medium level, it's not as low as we thought, then that means we would have to change our overall detection risk either to moderate or low. That has an effect on what we have to do for the financial statement audit, okay? So you see that this assessment of control risk is going to trickle down to our financial statement audit. It's going to affect our materiality. It's going to affect what accounts we have to audit. So we have to gather as much evidence as we can about internal controls in order to ensure that we are setting an appropriate level of detection risk, okay? But, whoops, if our achieved level of control risk, meaning what we found when we dug into the details, if it actually was low, then we're good. Move on to your financial statement audit. You don't have to revise your plan. You don't have to recalculate materiality. You don't have to do any of that. Stick with the plan. Move forward with your financial statement audit, okay? This is what I just talked about as far as how the assessed level of control risk is going to have an effect on detection risk. So I kind of put that diagram up on the board instead of covering it in the slide, which is okay. And then lastly, we are going to talk about this in more detail in chapter 7, okay? But in that circumstance where they said, we perform credit checks on all new customers, and then we realized, no, they actually don't. They said they did. They had a narrative description of their process that said they did. But then when we dug into the evidence, they actually don't do that credit check. That would be known as a control deficiency. It means the control failed. It's supposed to prevent or detect misstatements from the financial statements. Specifically, it's supposed to prevent selling to uncreditworthy customers. It failed. We call that a control deficiency. Any control deficiency that we find, we have to report that to management, okay? If it becomes so significant, either just the specific control that we're looking at, or maybe there's a few of them that accumulate to be more significant of an issue, then that needs to get reported to the audit committee, right? Remember, there's the board of directors that oversees sort of the organization in terms of that governance hierarchy. And within that board of directors, there's a committee, the audit committee, and they're sort of overseeing our audit procedures. If we find a significant control deficiency, we have to report that up to the audit committee, okay? We're gonna, again, dive more into that, the difference between control deficiency, significant deficiency. We're gonna talk more about that in chapter 7. But just understanding that anytime we find a control has failed, we have to report that to management. And if it gets to the level where it's more significant, more material, then we start pushing that communication up to the audit committee. Make sense? Okay,